Hi guys, I hope you are well. Welcome to lesson 2 of this particular module. And I'm going to try and keep this one brief. I don't want to, again, overload you with too much information, but if you remember, I spoke to you on the last lesson, and I spoke to you about framing my setups around these news events in relation to time. Now, I also said, and this is where it's going to start kicking in and making sense, because I also said that I am not interested in utilizing the news based on the direction. Okay, I don't believe news will encourage any type of direction in price. Now, contrary to what you might hear, you've probably heard certain gurus out there talk about saying that PPI always runs bullish or bearish or whatever. I don't care about that. Okay, I don't care about that. I don't listen to any of that rubbish. Okay, it's all nonsense. This is my cheat code to tell me the times to trade. Okay, this is the cheat code to tell me the times to trade. My cheat code to help me with direction is the DXY. And I want to introduce you to something else, which is going to help you with the cheat code to finding out the direction of the DXY. And that is going to be government bond yields. Now, what I want you to understand about government bond yields is we're using this as confluence to help us with direction in price. When you look here, you won't see price, you'll see percentages. And obviously you'll see time at the bottom, but on this side of the axis here, you don't see time. You don't see price, you see percentages. And what this basically means is the greater the interest rate, the stronger the currency will be. This is obviously US government bonds. So if the interest rate is good or strong, the DXY will be strong, meaning that Euro USD will be slower and weaker, meaning that we'll be looking for sells on Euro USD. What you have to understand is that if the price of the bond goes up, the yield goes down. There's an inverse relationship between the bond's price action and the bond's yield. And if you studied finance and economics and things like that, then it would be information that you would know. Now, if this is something that's kind of going through your head at the moment, then don't worry, because this is all going to be spoken about as we go along. That yield is interest. And basically, if your bond yield is bullish, the DXY is bullish. If the bond yield is bearish, DXY is bearish. Therefore, if the DXY is bullish or bearish, inversely, you're going to get different reactions with Euro, Pound, Aussie USD. So look at this, for example, because what you will notice as well is when you look at the DXY and you look at the US bond 10-year yield, they're not exactly the same. There are differentials. But what I want you to start focusing on is the swing points. Okay, the swing points. And when we look at what this particular chart is doing, you'll see that we've reacted from that gap. And we've been very, very bullish. And we're heading towards this area of an efficient price action. So I want to see this thing here move higher. And I want to see it reacting there. That's very, very basic, simple stuff. I'm looking to go from area of inefficiency to another area of inefficiency. It will then look to probably seek liquidity, which will be at this low. That's the nearest port of liquidity for me. If it breaks above this level here, the liquidity I'd be interested in would be at these highs right here. It's as simple as that. But right now, this is pushing higher. So when I look at the DXY, we're pushing higher. We have actually swept this liquidity here, and now we're pushing higher. Now price may well react in here. You would think it would react in here, but I've got a hunch it might actually react here. If the US 10-year yield pushes higher and reacts up here before it gets here, then it would react from here, but you'd probably see consolidation first, which is when you get differentials with the DXY and the 10-year bonds. We're in all sorts of different areas we've spoken about before. We've got breaker blocks, we've got areas of inefficiency, order blocks up here, that kind of thing. And it's just important to know where we're looking to go. Because on a weekly time frame, we have reacted in this imbalance here. And I mentioned that we're not in a particularly pleasant spot at the moment because of these areas. All we're doing now is we're framing this around what this particular thing here is doing. Because look, area of inefficient price action. Pushing lower. We've had a push up from maybe this order block, maybe this area of inefficient price action, but now we're reacting in here. So I'm looking to see what happens in here. Now, if we start selling off in here, I'm going to expect to see the same in and around this area here. Meaning my bias would be bearish at this level here. Meaning I would be bullish on the other pairs. Euro USD, Pound USD, Aussie USD. Now you might look at this and think, that's just irrelevant, I'm just going to stick onto the DXY. But trust me, this is what I look for to aid me with direction. Because it's an extra piece of confluence. If we look at here, February, first week of February was that low. What happened on the 1st of February? We made a low. Price started pushing higher. Price reversed around the 14th, 15th. Look here. Started to consolidate, and then price started making its way lower. Now, in terms of reversals, price moving up and down, there is a cheat code I'm going to give you in time, so don't worry about that. But what I want you to start looking at, I want you to, and this is the first homework task. All I want you to do is look for swing highs and swing lows on a daily time frame and dates on the DXY and the US government bonds 10-year yield. See if you notice any patterns and see what you can come up with. All you have to do is basically double check that these areas are correlating together. So you could open up a double chart here and you can just basically highlight that they're on the same time. So something like that, for example. And you could say beginning of Feb, beginning of Feb, middle of Feb, middle of Feb, vice versa. Just go back a few weeks, a few months, and try to see if you can start to trust this process. Because that is what's going to help you. Identifying that when this is pushing higher, the DXY will push higher. The DXY is what I'm using for direction, and I'm coupling that with the US government bonds 10-year yield. And I'm utilizing both of these assets to tell me the direction. And I'm coupling that together with forexfactory.com to help me frame when I'm going to look for a buy or a sell. And the higher time frame trumps everything. So guys, hopefully this has been insightful. This is an introduction to this particular asset, and I'll speak to you on the next one. Take care, guys.